Yeah, the markets are in full meltdown right now. The S&P 500 is down, the Nasdaq is in a free fall, and media anchors look like they just saw a ghost. So what happened? Trump just dropped a tariff bomb on a global economy, and the world is not happy. So in this video, which is going to be short and to the point, we're breaking down what exactly happened, why the markets are freaking out, and what you should do as an investor, both if you invest from the US or from the rest of the world. So here's the deal. Trump just announced massive tariffs on global imports, causing a financial earthquake, and everyone got hit. All importing goods now have a 10% tariff slapped on them, but some countries got a special treatment, and not in a good way. Vietnam, the poor guys, boom, a ridiculous 46%, almost half. Thailand, 36%, China, 34%, and so on, with as high as 20% for the all-time overseas friend, the European Union. World stocks, the dollar, and oil all tumbled on Thursday as Donald Trump's new US trade tariffs drove fear of a global recession. And it's not just fear. Companies like Apple literally found themselves in a situation that their revenue and earnings are going to be slammed down now because the tariffs on China are 34%. Because China is the base for much of Apple's manufacturing. Even analysts at JP Morgan said the tariffs are significantly higher than the realistic worst-case scenario that has been foreseen before. And in fact, traders have been dumping stocks and flocked to safe havens such as gold, the Japanese yen, and US treasuries. But not everybody sees this crash in the same way. Trump is calling this Liberation Day for American manufacturing, saying it's all about bringing jobs back home. And look, with a long-term perspective, in 10 years from now, this might even be a good thing for the American economy. But right now, everybody's seeing black. And while Trump called yesterday Liberation Day, Wall Street is calling it Trepidation Day. The announcement led to big reactions across the global markets. US stock futures dropped sharply, with Dow Jones Industrial Average futures dropping over 900 points, or 2.2%, Nasdaq 100 futures down 3.5%, and S&P 500 futures falling 3%. Major companies like Apple, Amazon, and Nvidia also saw painful declines. And just as US and global stocks declined, even the US dollar weakened to its lowest point of the whole year. So what is happening is actually no surprise. I talked about it even last year in my channel, and if you subscribed to it last year, you already knew that this was coming. Basically, this is what happens with the economy and why you already knew about it. Tariffs means higher costs for businesses, both American and overseas, which means lower profits, which means, yep, falling stock prices. It's actually pretty simple. And obviously, if you consider the long-term repercussions of these tariffs, you can see that the idea behind it is to force American companies to bring the manufacturing back to the States, because little by little we were getting more and more dependent on the manufacturing power of China and Asia. And as I said last year, with tariffs and the panic in the stock market, investors run for safety. So gold is skyrocketing, the classic "oh no, the world is ending" investment. US dollar is tanking because big investors are dumping dollars for safer currencies like the Japanese yen, and oil prices are slipping because if global trade slows down, so does demand for energy. So could this cause a recession, and what should we do about it? Economists are warning that this could slow down global economic growth big time. JP Morgan and Deutsche Bank are predicting this could shave 1 to 1.5% off US GDP growth. The higher tariffs we're seeing means higher prices for consumers, which causes inflation spikes, which is going to put more pressure on the Fed. And if other countries retaliate with their own tariffs, we could be looking at a trade war. And we all remember now how it played out in 2018. So now I have a couple of really important, really practical tips for you as an investor, so that you can actually use this crash in your favor instead of losing money like anybody else. First of all, please don't sell all your stocks in ETFs now only because you started investing recently and you are in the negative. The market has already lost a lot right now, so you'd be selling your stocks cheaper and possibly see the value come back up in the near future. So the best play is to keep what you already have and try to invest every month more and more the more the market goes down. This way, you're mathematically ensuring that you're investing as much as possible when prices are down. I call this tactical DCA because it's not just investing the same amount every month, but it's investing more and more when the market is moving down and less while the market is going up and the bull run is going forward. Second tip, don't try to time the market. If you have money to invest every month, don't just try to put it aside waiting for the end of the crash, because you're not gonna know exactly when it is. What you do know though, is that prices are cheaper than before. And that's what you need to know. Third tip, do the opposite of what your instincts tell you. Everybody, including YouTubers, is telling you now to invest in European stocks or global markets because the US is going bad. Me? I was telling you this last year, when the US was actually going great. Now that the US is facing this hard moment, now is the time I tell you that you need to invest in the US. And it doesn't matter if the price keeps going down in the next months, invest more and more and the US will come out of this crisis stronger than before. And if one day it does, and you see again a situation like last year, where the S&P 500 was doing like 24% per year, that's where you need to be careful and invest more internationally. And a last tip from me, invest in the markets that lose the most. Just like I said before, in the past few years, every YouTuber was saying, invest in growth, invest in growth, invest in growth. Why? Because growth was growing like crazy. And if you know my channel, in the last 2 years, I was actually telling you how growth was overvalued and due for a correction, and that instead, it was better to balance with value. Now it's the other way around. Growth is the sector that is losing the most. In fact, the Nasdaq 100 and ETFs like QQQ lost more in 12 months than the S&P 500. And what does everybody say? Buy value. Me, on the other side, I tell you, buy more of the growth sector now, the more prices go down. Do the opposite of what everybody else does. But again, with moderation. I don't mean that you must buy only tech ETFs like VGT or QQQ. What I mean is that the more prices go down, the more you should invest more in growth than value. And the more prices go up and the bull market goes on, the more you should invest in value and less in growth. Now, if you are a European investor, I know right now it's harder for you than for an American investor. In fact, you're probably looking at double the crash that Americans are seeing. Because in your case, there is the loss of the American stock market plus the loss of the USD compared to the euro currency. In fact, while VOO, the S&P 500 ETF from Vanguard for US investors, went down 10.6% since the peak in February, the European version VUAA went down almost 16% in the same time frame. The difference in loss of about 5% is due to the fact that the US dollar is losing value compared to the euro since February 2025. Now, when it comes to this, you can either keep investing in the same ETFs like VUAA, or buy hedged ETFs like SPPE, the Spider S&P 500 Euro Hedged UCITS ETF. Hedged ETFs are designed to reduce or eliminate currency risk for European investors. In this case, if the ETF holds assets denominated in US dollars, like US stocks, the fund manager uses financial instruments like currency forwards or swaps to hedge against US dollar-euro fluctuations. This is going to give you a higher performance than the American S&P 500 in times in which euro gets stronger than the US dollar, and lower performance in times in which euro gets weaker than the US dollar. Now, I want to be clear when I say that hedged ETFs are not always better. I always hear that it's the best way to reduce currency risk, but this is just a half-truth. When the US dollar gets weaker than euro, you're happy that you have this risk hedging. But when the US dollar gets stronger than the euro, then you're also gonna get lower results. And you also have slightly higher costs due to the hedging process. Alright everyone, I hope this video was useful. If it was, drop a beautiful like and subscribe to the channel. Drop a comment if you want, and other than that, I wish you a great day, and as always, I'll see you in the next video. Ciao!